Hi, welcome to this podcast where I'm going to be looking at ratios, starting ratios, and also profitability ratios. These ratios are the easier ones, so we'll just cover a little bit of general theory to start with. The general theory is, first of all, we're going to look at what profitability is versus liquidity. Profitability looks at things mainly in the income statement, not totally, but mainly, and it's how much profit we're making in relation to something else. Liquidity ratios, for the most part, focus on the statement of financial position, but there are things from the income statement, and it looks at the ability of a business to generate cash to meet any short-term liabilities. Ratios are only really useful for using to compare performance and time periods for the same business or with other businesses. The reason for that being the ratios are so different for different types of businesses. Some businesses, for example, a supermarket, they generate cash very, very quickly. The goods come in, they get sold, they get cash straight away. Other businesses, it takes a lot longer to generate cash because you've got to sell goods on credit because that's what everybody else does. And therefore that cash may come in up to 90 days after you've actually made the sale. Some ratios, and the ones we're doing today are the simple ones. Generally, we expect them to either be high or low. And if they're high, generally they're good. If they're low, they're generally not good. But a lot of the ratios, particularly liquidity ones, can be too high or they can be too low. There's like a Goldilocks bit in the middle where it's not too hot and not too cold. And you've got to be able to explain what the ratios mean. Formula, I'm not going to go over these too much because I'm going to do an example with you and then show you what to write, so don't worry too much about these. Just look at the return on capital employed very quickly. The profit figure we use is the profit before interest has been deducted. And we do that because businesses make a choice about capital. When we're talking about capital and the ROCE or return on capital employed, what we're talking about is long-term investment in the business, not just the shareholders' capital or equity or the owner's capital or equity. So we need to add on to that the long-term or non-current liabilities in the business. And because of that, a business makes a choice about how much of the long-term investment comes from owners, how much comes from bank and other sources as loans. And therefore, we wouldn't be comparing like with like if we're deducting the interest straight away, because by deducting the interest, we're taking away the return that goes to these long-term or non-current liabilities. Looking through our example of what we need to know and be able to do. Okay, I've done a income statement to statement of financial position. Most of the information comes from here. So we don't need to go back up again. We've got a gross profit of 83,000, operating profit of 23,000, and a profit for the year of 18,000. And the only other thing that we're going to need to know when we get down to looking at the formulas is how we calculate the capital. I've done this here for a sole trader, although this part of the layout over here for the income statements is a limited company. Okay, obviously we can be expected to do it for any type of company, partnership or sole trader or limited company, but we're going to use the 42,000 for the capital and the 50,000 of the mortgage when we're looking at total capital. So the total capital is going to be 92,000. And then there's a load here of ratios that we're going to compare the previous year for the same business. Okay, gross profit, we know the gross profit for the year is 83,000. If you'd looked at the top of the income statement, the revenue is 120,000, multiply it by 100, that gives us 69.17%. And notice for these ratios, I do them all to 2 decimal places. That's what you'll be expected to do in an exam. Markup's a little bit different. It's a gross profit, but the gross profit is as a percentage of the cost of sales. So we're looking at how much we increase the price of the goods we buy by, as opposed to here, which is where we're looking at what percentage of the selling price is coming in as a gross profit. And in this case, gross profit is, there is something wrong here. Give me 1 second. Yeah, the gross profit is 83,000. I've put those two the wrong way around. And the cost of sales is only 37,000. So there actually should be a much higher margin, I think, than I've calculated over here. So let's just reverse these. It's going to be 83 divided by 37. So that's actually a super high markup. They've got a 224.32% markup. So they're increasing the cost of the goods quite significantly when they're selling it on. Profits, percentage to profit to revenue ratio, that's a profit for the year, which is 18,000 divided by the revenue and multiplied by 100 again, and to 2 decimal places, that comes to 15%. And the final ratio we need to look at is the return on capital employed. And notice I've used a different profit figure now. I've used this profit figure before the interest being deducted. Be a bit careful with sole traders accounts. I've seen it done on exams where you've got the interest as an expense and you're expected to add that expense back on. So increasing the profit. Divided by the capital employed, I showed you how to calculate that earlier, and that comes to 25%. Right, writing about ratios, it's important that we can do this, and it's important we understand what they mean. So what does a ratio of 69.17% mean? Well, for the gross profit, that means that the gross profit, the bits, if you like, from the selling price that's left over for the business to pay their other expenses and then to be a profit, is 69.17 cents or 69.17 pence for every dollar or pound of sales. And it's improved because it's increased by 14.17% from the previous year. So always talk about how much the improvement or the deterioration, the increase, the decrease has been, and calculate it. That's very often worth an extra mark. And the gross profit, generally we want it to be high, and it's improved because the business has either been able to either increase the selling price of the goods sold or reduce the purchase price. And it's important we talk about increasing the price of the goods sold or decreasing the purchase price, or vice versa if it's got worse, decreasing the price of the goods sold or increasing the cost of purchases. Because for this ratio, if you look up here, there's only two variables in it really. It's how much we sold things for or how much we bought them for. And if we sell more goods, so if we were to double our revenue, we would also double the cost of buying those goods. So the actual ratio, although the profit figure, the total amount of gross profit would go up, what happens is the ratio between the two, the percentage that's cost of sales or that's profit, will not have changed. If we doubled the sales, we would have 166,000 of gross profit. 166,000 divided by 240,000 is the same percentage. So it's a selling price or the purchase price for the first two ratios. Very important. You'll lose marks in an exam. Okay, second ratio was the markup. The business increased the purchase price of goods by 44.58 cents for every $1 of purchases, and it's improved because it increased by 4.58% from the previous year. And again, the markup has increased because the business is either buying goods for a lower price or it is selling those same goods for a higher price. The profit for the year, okay, that means that for every dollar of sales, the business is making 15 cents of profit. It's improved by 5% for the previous year. And the profit for the year can either increase because the purchases have decreased, the expenses have decreased, or the business has sold either more goods or the same number of goods at a higher price. Okay, so it's much broader the reasons why that can improve. And that's because the expenses of the business don't necessarily go up or down depending upon the number of items sold. So if you think about a shop's rent is the same whether they sell $100 worth of goods or $10,000 worth of goods. So you sell more goods even if it's only at the same price, and in relation to those fixed costs of the actual rent of the shop, there's been no real change. Return on capital employed, this one you need to think about. It's a bit like a bank interest. So compared to bank interest, if you've got money invested in the bank, 25% is actually very, very high. Okay, but the return on capital employed means that for every $1 of long-term investment, the business is paying back or returning 25 cents or 25 pence of profit. It's declined from the previous year by 5%, and this could either be because the amount of profit has decreased or there's been an increase in the amount of long-term and capital invested in the business. So if you look at it here, you've only got two real variables, profit or capital. So if this figure gets smaller, either this figure, the amount of profits got smaller, or the business has gone out and got more capital. Right, I hope that was all good for you guys. There's some questions for you to have a go at doing here on sheet number 5. Okay, so for those of you that I teach, you need to go through, work out the questions and send them back to me. Otherwise, good luck and speak.